All right, folks, this is a chapter on bonds and bond pricing. It's chapter 6 in the book that is specified for the course. And here are some targeted homework questions, some problems here. And if we work through these problems, we'll have a good understanding of the material in the chapter. There's 67 slides here, so just so you can pace yourselves, and I can pace myself. So something about bonds. So when you think about bonds, maybe you think about this picture, or maybe this picture. Not sure if you can see the smile on his face, but Barry Bonds was smiling in that picture. Not sure now. But anyway, see, I'm starting on a sort of on the shadow side of bonds. Bonds are not risk-free. These are some typical beliefs that are associated with bonds. Bonds can lose value, are volatile, and can have a net negative return. Just in these 3 lines, I have sort of dispelled, some very firmly held beliefs, and as you know, incorrect beliefs. People generally think stocks are risky, bonds are not. Bonds don't lose value, bonds are not volatile, and bonds usually, have a positive return. There's some truth is in there in all of that, but not entirely. Bonds can be used as a steadying device for fixed income flows. That's correct. Bonds have great value in an asset allocation program. Absolutely great. And in fact, I've demonstrated that in that Mac investing paper, which most of you pretty much know about, where bonds is one of the 6 asset classes. MAC stands for multiple asset class investing. People are always within the box of investing, which is just equities, equities, equities. Bonds, a very simple classification of bonds can be government bonds versus corporate bonds. People generally think bonds are issued by the government, and that may be the case in some other countries, but definitely not in the US, which is a highly evolved capitalist system. And so the corporate bond market is approximately, this is some dated numbers here, $785 billion in 2004, total corporate debt. So corporate debt is basically bonds issued by corporations. So IBM will have bonds, Microsoft will have bonds, and of course they have stocks. The idea here is not necessarily to stress the numbers, but stress that this means there's a wide range of options to choose from when selecting a bond to invest in. Basically, there's a world beyond stocks. So in a way, I'm sort of cleaning up, deprogramming investors' beliefs, and you are part of that investor, mindset. And that is part 1 of this chapter. Stocks versus bond. This is like a classic picture from slightly dated, 2003. And I'll add more recent information to that. But this is the reason why people don't like to invest in bonds. But what you see is just the story of like the tortoise and the hare. So blue is bonds, and red is, stocks, the hare, the rabbit. And see, up to 2000, I mean, if you would actually not feel comfortable mentioning to anyone that you had invested in bonds. I was working in Boston. I was, firmly inside the asset management industry. And they were firing bond managers, bond portfolio analysts right and left. I mean, entire bond desk. It was like, what is the point of investing in bonds? I mean, really, and these are informed people talking about things like that. Because if you were invested in technology stocks, especially internet stocks, you could have like a return of like 10 to 15% a month, Or if you had 1 or 2 stocks, it could be like a 100% return in a month. Something would double up. And then, of course, this happened. This is the first one, 2000 to 2003. And this is where, it's sort of like, well, I've seen this before, but it sort of gave me something to think about, the basis for the big charts chapter. This is a correct graph here, correct chart. So this shows the amount to which a $10,000 investment grew, as opposed to just the price return. So you had you had $10,000, and then the amount that it grew, and these are the these are the dollars in. So like 10,000 became 50,000, 40,000, and from 1990 to 2003, 10,000 stocks became 37,000, 10,000 in bonds became 34,000, generating an annualized return of 10% versus 9.7%. Not bad, right? And on top of it, what happens is because of the availability heuristic, which is like right now everybody's comfortable, right? Josh just mentioned, that 4 days of up market in the Dow, and I know he didn't say that, but that's going to continue to go up. So a lot of investors, they feel comfortable investing around here. And so they actually have a negative. They have a capital loss when they invest. These pictures, they look great because you're thinking, okay, somehow you were anchored. See, anchoring is another thing that Addison and her team will talk about, is you're anchored to this point. Yeah, sure, you invested here, you're still fine, right? But why did you go here? Why would you invest here? You won't invest here. You'd probably invest here or here. So you have a negative loss. Whereas a program of regular investing, in something that is consistent and stable, will yield entirely different results. But there we're sort of going on a slight tangent there. It's hard for me to, it's like I know something I've shared there because you never come back to it. It's fine. This is a picture, as you can see. This is from Big Charts. That's why I call it the Big Charts picture. 1997 to 2008 is the first one here. And that's 1997 to 2008. And you say, sure, Pank, bonds did not lose much value, but even after one full bear market, I'm still better off with stocks. Should go back to the previous. Yeah, how I was doing that. And then this is updated to 2010. I'm sure most of you have recognized that this black line here does not include the coupons or the interest that has accrued to the bonds, because this is a bond fund and this is the S&P 500. So the S&P 500 is basically generating the same amount of returns despite the higher volatility. And the previous case, actually high returns despite the volatility. So this is my own software. It's basically coded in Visual Basic, but it spits it out, and then eventually I convert it into an app. The picture here is different, and you guys may want to write it down, but probably you already know. TLT is the bond ETF equivalent that I'm using here, which is in red. And SPY is the equity equivalent, which are both tradable, so I can actually do things with it. And the delta is 47%. So over the period from December 04, which is the first when TLT existed, from 2004 to 2012, this is actually the real picture. So bonds outperform stocks by 47%. And trust me, I'm no salesperson here. I'm not trying to sell you that you should invest in bonds. In fact, the last 1 year, I would sort of slide it into the class that, everybody's now getting onto this bond gravy train, And of course, as you know, this year bonds have been really hammered. But they've actually come back. And if you look at the total returns, they're fine. But when it's like, the best time to jump out of the pool is when everyone's in the pool. That's when the blue lights come and the balls start flying around, Been there? Done that? Really? See, in my software, first I had to recreate how these guys were making their charts. And this is this shows bonds in a very poor light. So this is VFINX, which also you can write down if you want to start, doing your own little experiments. VFINX is the equivalent of the SPY. The SPY is an ETF. VFINX is the mutual fund, the world's largest S&P 500 tracking mutual fund issued by Vanguard. And you'll actually see it. Within 5 to 10 years of graduating from here, you're going to see it It's one of the mutual funds that's there in a lot of retirement plans and investment options for companies. So when you see that, you're like, I'm investing in the top 500 companies at one of the lowest expense ratios in the world. It's about 0.1% or 0.15%, you know. And I know I don't want you to, but you could if you want to. One of the world's most well-managed and indexed bond fund is VBLTX, B for boy, VB. So there, you know, there's always a little hint in there. Vanguard bond, long-term, X. Usually something that ends with an X is an index or a mutual fund. ETF has 3 tickers in it. Mutual funds have 5 in them, and all these. And you see once again, you know, the same picture you're seeing, but this is not through my software. This actually, I like to pick on Josh actually. You know, this is like up and away. I had class at this time in 2008. I said to the class, I said, hey, good time to pick up Goldman Sachs. I remember sitting right here. It's a good time to pick up Goldman Sachs. Everyone's like, oh, bank, really? Look at that red line. That's the US equity market. That's minus 40% right there. It happened just in like a month. I mean, the country was frozen. I don't know. You guys knew what was happening a little bit. I mean, this you may not see it there in the back. Shane, can you see it? This is a red line here, okay? So we were here and then we are here, right? So this is not part of the vertical axis here. But notice, the interesting thing actually is bonds losing value too, right? Look at that. Bonds were not supposed to lose value. That's why it's always different. It's always different. Because this time there was a liquidity freeze. In fact, if you put gold in there, gold also lost value. All tradable assets lost value. Typically there's a negative correlation, you know. You would expect one goes down, something else goes up. That didn't happen. So Josh here is like, why? This was the time. You know what the Dow was here? Pretty much 7,000. It was 6,900 on a bad day in March of 2009. It was 7,000. That would have been the low-hanging fruit, right? You just buy some equity, right? That's all you have to do. Just buy the SPY, forget about it. Now it's what, 14,000? I know. It's like trying to get to 16,000, right? More than double on an index. So then all the behavioral finance things will come up. And that's the sort of I wrote. I know you guys have a lot to read. The fact that Robert Shiller got a Nobel Prize this time, after 2002 where Kahneman got a Nobel Prize, it just shows that there's an increasing recognition that the valuation of assets has to do with the human psyche. It's not like overnight, you know, like overnight, like 500 companies lost so much value. I mean, what, their account books just froze, you know, everything. No, it was, we were assigning value to it, you know. So there you go, guys. And then, you know, you can, I can run it and I can show you where it would be right now. Live demos are always dangerous to do. That's beta, that's my beta program. That's not what we want to do there. Anyway, the picture is going to be like this basically. So here's, this is, actually that red line corresponds to this, and then this is March here. So that was October, November. And then, see, this is where even the brave, you know, they get what's called shaken out. Suppose you were brave and you looked at that picture, and suppose a couple of my students, you know, sort of bought my, not my advice, but my nudge. They will go buy Goldman Sachs. I mean, they'd be chewing glass for the next 3 months. And it's difficult, you know. Put in 10,000 Goldman Sachs, now you're looking at 6,000 after 3 months, you know. You're thinking it's going to become a single-digit stock, then maybe, you know, maybe I'll get an email, or maybe they'll just sell it quietly. And then there it happens. It's called shakeout. I mean, even, you know, right. Jimmy Cramer says that, you know, the market will keep butchering people with a very blunt knife until all the buyers turn away. There's no buyers left. And that's called, you know, there are no buyers, and the selling dries off. At this point, the selling dries off. Everyone has sold off everything. For no reason then, even on bad news, the market will start going up. That's called the selling has dried off. There's nothing more to sell. You know, you pretty much sold your whole portfolio. You moved into bonds, cash, something. So, all right. So having given that, see, that's not part of the chapter in a way, but you know, without that, this would be just, it's like, why am I doing this? So I just showed you the dynamics of bonds, stocks in live. I showed you that there's sort of a negative correlation. But at the same time, I showed that there can be positive correlation as well under certain circumstances. And most important, I showed that they are actually definitely not an inferior asset compared to stocks. In fact, on the risk-return space, it's a superior asset. But people can say, okay, well, we can't eat risk, you know. So the return aspect here, no problem. You broke something actually. Yeah, no problem. And so on the return aspect, also, so the third item is that they can actually stand their ground against stocks on the return aspect as well. So now coming back to, you know, classic material types. Key features of a bond is basically a certificate of debt issued by a government or corporation that guarantees a payment of the original investment plus interest. And bonds, they have a face value, a par value, and it's sometimes not specified, and so you just assume it's 1,000. So that's for the purposes of homework and calculations. It's sometimes called par value, face value, maturity value principle. Important item there, that's something new, is something called coupon interest rate. Most of you know about interest rate through your savings accounts maybe. Some of you probably know of dividends. And making sure the light is on here. It's just like stocks, they pay dividends. Bonds, most of them, they actually have a coupon associated with it. A coupon is no longer a coupon. If you think of a movie ticket, you know, you get the small movie tickets. So you used to buy a bond and it would have like, you know, a set of those coupons. Then you'd go to the window there and they'd tear the coupon, they'd keep the coupon, give you some cash. But now, of course, all of it is done electronically. And the coupon is generally fixed. Some other items with bond, there's something called a maturity date. Now, if you notice, you start thinking, you know, stocks don't, we haven't done a chapter on stocks actually. Stocks is, I sort of do it afterwards because it's more complicated, even though most people think stocks are easier. So this maturity, there's no maturity for stocks. That's why, you know, sometimes, you know, they find a wooden chest in some mid-Manhattan apartment, you know, where some very old people, they passed away. Or find some AT&T stocks, you know, 200 shares, 300 shares are worth, you know, $500,000 or something. Because stocks, they don't have an expiration date, bottom line. But bonds have a maturity date, they have an issue date. And bonds also, like, there really is no free lunch, except maybe at your mom's table. But even then you have to listen to her, you know. No, I mean, everybody knows exactly what I'm saying, you know. Right? Oh, I call my mom every 3-4 days. It's been, what, 22 years now, you know. She comes every 2-3 years, but she gets no. But yeah, and she gives me advice on the stock market. It's amazing. she says, so how's the NASDAQ doing? You know, it's interesting. But yeah, bonds, because I really want to, you know, just, I think you know my style a little bit. I mean, really, conventional wisdom is factored in. So I don't talk about conventional wisdom. Conventional wisdom is bonds are risk-free, pretty much. I know people know that they're not risk-free, but most people associate bonds with risk-free. The primary risk comes from three sources actually, and one of them is default risk. Ask the bondholder of Lehman Brothers, 180-year-old organization, they're holding Lehman bonds. In fact, there's a Lehman bond index. It still is there actually, the Lehman bond index. And the value of the bond is zero, So bonds can actually, have no value if the underlying company, defaults on it, or if the company ceases to exist. And then there's something called interest rate risk and prepayment risk. And reinvestment risk, actually the fourth one. We'll cover all of it today. It's amazing, 726. And basically the default risk that issuer will not make interest or principal payments or maybe even cease to exist, Simple stuff. Special types of bonds, you can read up on a couple of these. There's something called zeros. They just call them zeros. And zero coupon bonds, they basically are highly volatile. They don't pay any interest. So they came up with bonds that don't pay interest. Very interesting, Then you have junk bonds, putable bonds. Junk bonds are rated BA or lower and used to finance mergers and takeovers. They're high-risk bonds with high yields. They're almost like small-cap stocks, really, junk bonds. And then the putable bonds, they actually have ETFs for a lot of these. By the way, here's my video stream, which I'm sure that some of you have seen. But if you want to recap, initially the idea was only the online people would have access to it, and then after I spoke with the office here, I said there's no reason, especially because you guys are contributing in the production here, the landliners, I say, as opposed to the onliners. Both of you are basically populated by the same human beings. But you can click on this and you can see. So you can see 6 views here, 7 views, 31 views, 19 views. Don't hit the down thumb button on any of these, okay? Please. I mean, at least that much you give me, right? So anyway, I think I've posted that link. And if somebody doesn't have it, just let me know. Or you could probably find them by doing some simple search. Why am I here? Why am I doing there? Or just want to show you, junk. So J and K, I mean, what would you think? There's an ETF called junk here. Yeah. Solid ETF actually. Because the problem with junk bonds is 25% of them actually default. 25% of them. So if you hold 4 of them, 1 of them will be gone. So you lose 25% right away. So this is obviously a portfolio of junk bonds. And compare it to, let's say, IEF, which is intermediate term treasury bonds, and you'll see here, it depends. So if you look at the return from here to here, this is going to just knock the lights out of this one. But this is stable here. It's held its value. And here, as the stocks went down, junk bonds went down. Junk is in black. Now if I change this, see, these are all the things you'll be careful about now. When financial planners say that, hey, you know what, you should invest in junk bonds, doing great. See? I mean, obviously, they're more volatile and higher default risk. So in fact, look at that. There's a divergence here. Government bonds are losing value. Junk bonds are stable to up. So you got junk there. Zero. I want to show you the zero here. See, these are mutual funds that have zero coupon bonds. There's an ETF, there's somewhere, you can find it. You can find it, it's fine. There's nothing more to it. That you no longer have to invest in a single bond. Bond investing was also very difficult for investors because, you would have to set up a account with treasury.gov or something, or there were large denomination amounts, $100,000, $10,000, but now you can buy, see, this is a section here in bonds, TLT for $105. BWX is international bonds, EMB is emerging market bonds for $109 and highly liquid. In fact, you can literally do a little bit of a color test here. So here, these are NASDAQ stocks, all NASDAQ sector, sort of all down today. Biotech here down 3%, and this is a little bit of safety there, and but the broad indices are all up. So it's very interesting, both stocks, and see right now you see it's strange times. Always strange. Bonds are up and stocks are up too. Very interesting. So anyway, just show you the ETFs that come with it. Something called callable bonds. And there'll be a question on callable bonds which I'll do with you. I think I have 1 hour easily with you. It gives the issuer the right to retire of a bond prior to maturity. So suppose they issue a bond promising 10% interest rate, but the interest rate has gone down to 3%. They're stuck. They're stuck with paying 10%. And so they'll put in a feature there. That's the callable bond. I mean, they literally withdraw the bond and then refinance it at a lower rate. But no free lunch once again. A callable bond, then there's a little bit of premium that is built in favor of the buyer. And so it basically gives the issuer the right to retire or pay off a bond prior to maturity. So these are some things you can see. Soft topics. You can read this. Adding a call provision affect the price of a bond. It helps the issuer but hurts the investor. And so basically, the borrower is willing to pay more, lenders require more on callable bonds. The lenders are basically you and me. Sinking fund provision requires the issuer to retire a certain portion of the principal annually over the life of the bond. A lot of creative finance that goes on in the bond world actually. Bond financing, that's how municipalities, they finance their roads, their street lights, their schools, libraries, so much. And so in order to generate some predictability for the investors, you can have a sinking fund provision. What it is a certain portion of the principal is retired. So you're initially investing in a $10 million bond, but then as the county collects taxes and all that, some portion of it is retired. So you're basically holding less debt. So it's less riskier. So a bond without a sinking fund is somewhat riskier. So obviously it will have to pay a higher rate. See, these are where the lines, where that no free lunch, that famous no free lunch sort of comes from. There really is no free lunch. You don't want to have a sinking fund. You'll have to pay a higher rate to get investors to invest in that fund, because the other municipality is offering a sinking fund option there. When I hit the calculator just a little bit, because you've done time value of money, you'll see why the sequence of chapters like that. So financial asset valuation, no major formula here, looks like it, but time and again we'll see this. End of the day, it is the present value of future cash flows. That's what it is. And this is so simple, and within the simplicity is embedded the impossibility. So what is the impossibility? First is you have to be correct on what the cash flows are going to be in the future. Second is you have to be correct, and we are talking only 3 aspects here, 3 dimensions, if you simplify it, and even then it's so impossible. So you give me the correct cash flow for every year for a company, tell me for how long that cash flow is going to exist. Ask that in case you think that, oh, well, why should we answer that question? Apple is going to be there forever, Microsoft. Well, ask that question to BlackBerry people or Lehman Brothers investors, I mean, what is going to happen to BlackBerry? I mean, really. I mean, they've got good machines. I mean, those machines are any value? I mean, they've got some soldering rods, irons, something. What do they do? They make calculators, shiny calculators. Christmas lights, right? We could have Blackberries that we'd press the button, they would have some nice lights because the screen is still working, right? You could, right? See, it's funny, technological obsolescence is amazing. I bet you guys, I've got a ton of technological junk in my basement. It's like, I got stuff that's like of historical value, I mean, it's like really beautiful stuff, it's just of no value, I mean, when I joined my program, we had someone in our program, he was a NASA scientist. He was like in his 50s, and he was in the program. I was 25 years old. And when he was leaving the program, he gave me an Atari personal computer this big, you know. It's just so nice. It's so nice. It's this big. It's very nicely done. Made in like 1989, something like that, you know. I mean, it's a real computer. It's got like buttons, raised buttons, everything. So many, like there's a separate switch for on, separate for off, you know, those days. Now you just press the same button, you know. But technological obsolescence, so, you know. So anyway, technological obsolescence, how do we get there, you know? Cash flow of BlackBerry, you know, how long and how much? And then the mother of all variables are the interest rate, the discount rate. People generally think something hits zero is going to go back up, you know. So the discount rate close to zero is going to go back up. Go ask a Japanese investor that. For 20 years, they basically have a zero interest rate policy. So if you're making a bond, if you are making a bet on bonds, that bonds are going to lose value, interest rates are going to go up, you're going to be wrong. And it doesn't happen. Same sort of stuff is happening here in different forms. So, but anyway, to simplify it once again is basically you take the present value of all this. The reason I'm doing so much talking about it is what is not obvious is the impossibility of having even these three variables lined up. And if you want to value a company like Apple or BlackBerry, you got like at least 20 more variables in there. And then the interplay within those variables. Those are the interaction effects, you know. And that's why, you know, it's just, I think Newton said, somebody sent me that quote that, you know, Newton said it's easier for me to calculate the direction and velocity of heavenly bodies than the spirits that govern the markets, you know. Because it's intrinsically a geometric ground in motion. So basic bond valuation, look at that, it's just an application of that. That cash flow is replaced by int. Int is the annual bond interest in dollars, which is basically the coupon. In this case, it's simpler for bonds. See, that's why a lot of like heavy quants, they're actually on the bond desk. In my experience, you know, a lot of bond people I worked with, they had like physics degrees, electrical engineering, and yeah, and math, yeah. Because look at that, see, they don't have to make a forecast. So they don't have to worry about, you know, whether BlackBerry is going to be good or not good. They just know the coupon is there, so it's stable. And then M is the maturity value of the bond. And divided by the interest rate factor, and the counter that changes with the year is N. Notice this last term is there are two of them. There are two cash flows in the last term. That's something to keep in mind, because not only will you collect interest in the final period, but also your principal will be paid back to you, so it has to be discounted. So sometimes students forget that, but with the techniques that I'll show you, the calculator, you won't, you know, because otherwise it'll give you an error. So value of a bond, interest rate, par value of the bond, KDN. How many of you want me to speed up on this? Or, I mean, are you like totally familiar with bond pricing, or you want me to go over, you know, show you some examples? Officer Eric? Good at that pace? All right. Sure. All right. Yeah. I just have 18. I got 50 more looking at me here. Fine. It's fine. Yeah. We all have 24 hours in a day. No? Why do you laugh?
You haven't figured out how to do something about that yet?
I haven't figured out what? How to?
How to do something about that yet?
Do something about that?
I would have figured you would have come up with something.
Oh, no. There's some problem in life that cannot be solved, you know. I do have an approach towards it. It's like sleep less, you know. I mean, yeah, time optimization. I actually average 4.5 hours of sleep. I actually have a chart. I can actually pull it up on the web, you know. Really, yeah. There is a standard deviation. There are times where it has 11 hours, you know, sleep. Yeah, it's actually Thursdays. Like tonight, I'll be so wired up after class that you can't go to sleep actually. So you're like totally exhausted and all that, but you still can. And I'll just do some, you know, some twittering, some things, you know. You guys sometimes see that. Mike, did you see like 15 of my tweets last night just like that, one after the other? Yeah. I should show you that tweet actually. It's funny. It's good. Yeah, and then I crash. Yeah. But I get the job done. I think that's what it is. It's like I'm a little bit of a procrastinator. But then I'm a responsible guy, if I may say. So I'll never be a no-show. I'll always do it. So how do you do it, You do it, then you have to okay, now I gotta, so whatever is not necessary, so as the time, as the deadlines come closer, so then everything that is not necessary, like organizing your room, like having the books all lined up, then it's not necessary at that time, Shaving something is not necessary anymore, Eating is not necessary. Sleeping, that if it really comes down to it, sleeping is not necessary. Saying hello to your kids, even that is not necessary. I mean, really. Because I do have figured this out. You can't be in two places at the same time. A lot of people stress about that. They really try to be in two places at the same time. Really, I mean, think about it, Listen, I'll get an email, I couldn't do that. It's because you want to be in two places at the same time. So you have to, so you have to have your priorities, yeah. But, oh yeah, 24 hours, yes, slide number 18. Yield to maturity, yeah. So that's the return to a bondholder. See, it's very deeply rooted, problematic ideas actually about calculations. What this yield to maturity is doing is, if you're the holder of a bond, your return is not only the change in the price of the bond, but also the interest that you've collected on the bond, and on top of it, the interest on the interest, right? If you're holding a 10-year bond, you get some interest after suppose you have, $100,000 invested, the interest rate is 10%. You get $10,000 at the end of the year. That's going to get reinvested, partly eaten up, something. What about the interest on that? So all that gets factored into YTM. With stocks, people don't think about that. They say, okay, you know what, I bought IBM at $100, now it's 180, so it's 80%, that's it. Even there, dividends are paid out. So, but the yield to maturity is definitely, the way to calculate the rate of return earned on a bond held to maturity, also called promised yields. And the bond value constantly fluctuates over the lives due to external forces and the passage of time. And you can see that here. I mean, you can look at anyone, It's to TLT. It's fluctuating. The par value is, look at that here. It's cratered this morning. See, this is the haircut, See, YTD, that's YTD actually. Year to date, the price here. And but the total return actually would be right around here. In fact, it's very interesting. My favorite site, one of my favorite sites, it doesn't show up anymore. Oh, there it comes up here. So ETF replay, there actually we should do that here. This is actually good. Total return versus price return. So basically, this is doing what my app does. So you guys can, if you don't, you can do that. But the only thing is they have only limited history and only for ETFs. You can't use mutual funds or stocks in there. So let's do TLT here. And yeah, last 12 months. I'm surprised at this number. Minus 11% is the total return, and the price return is minus 13%. That is, yeah, that's what it is. That's 36 months, let's see. So this is sort of like a fun tool where you can actually see the differential impact of the non-inclusion of dividends. In this case, non-inclusion of interest. Total return versus price return. And what is the discrepancy here? It's plus 5%, plus 16. See, now it starts compounding, 3 years. 11% difference. That's quite a bit. And if you go further, see, it's difficult to go back further, on this and all that. But it still gets you something. You can always look at that. Otherwise, looking at those charts on the main websites, it's really useless. It really is. Because bonds, they don't have any price for bonds. But the thing is, bond ETFs are there, so people punch it in. The yield to maturity is the discount rate here that we need to find. So we have the interest amounts, the maturities, and the current price at which it's trading. We know that, so we can find the yield to maturity. We use a calculator for that. What is the discount rate? Is the opportunity cost of capital. And the nominal discount rate, as you know, is the sum of the following. This is the real rate of return, inflation premium, liquidity premium, maturity risk premium, and default risk premium. These are the primary variables that go into determining the nominal interest rate. And so as the US as a country became a riskier investing proposition, the default risk premium went up. So it all literally ends up in a number. Default risk premium goes up, the interest rate that the US government has to pay on its debt goes up. If that goes up, that's the next topic. If the interest rate goes up, the price of the bond actually comes down, which is a very non-intuitive relationship. Longer the maturity date, higher the interest rate, lower the price of the bond. Higher the liquidity premium, that means less liquid than asset it is, the higher the rate you have to pay. It's all intuitive, but so here's a trivial case. What is the value of a 10-year 10% coupon bond if the discount rate is 10%? So one thing that you have to sort of train yourselves by a little bit of practice is distinguishing between the discount rate and the coupon rate. In this case, both are the same. But they have, really it's very important, otherwise you won't be able to do the homeworks and all that. The coupon rate, you can circle it and, just say equals PMT, in your calculator key, PMT. And this RD, just put equals IY. That's the interest per period, interest per year. And the two are very different. And this 10% coupon, next to it, put a dollar sign. You always convert it to a dollar amount. And I'll explain all this. See, that's why, one needs to not just post the slides, but, have some discussion about it. So what is 10% of 1,000? And then you say, well, Pank, where's 1,000? And I, on purpose, didn't include it. 1,000 is the face value of a bond, which is assumed to be the case. So 10% of 1,000 is 100, so you get $100 of coupon every month. Discount rate is 10%. So that's your RD there. And you have 10 of these. So first do 100 divided by 1.1, and you sort of agree that it's 90.9. And then see time value of money is kicking in. $100 10 years from now is only worth $38 today. And then what do you think 1,000 will be? That will be just multiplied by 10. You add it all up, it's going to be 1,000. So that's also the trivial and the interesting case actually, that if the coupon rate is equal to the discount rate, don't bother calculating the present value of the bond. It's going to be the same as the face value, whatever be the face value. Let's make it slightly more interesting. So in this case, the bond consists, the present value of the annuities is 614, the present value of the maturity value is 385, and so that's $1,000. You can use the calculator. 1,000 is FV, payment is 100, because you're getting it, so it's plus, it's coming to you. 10, 10, and compute PV, you'll get minus 1,000, which is exactly what we did. See how much simpler it is. Now, let's change a few numbers here. Let's just do this here. Let's say 1,000, if you want to. 1,000 is the future value. Payment is 100. Remember I said $100. Nowhere in the problem it says 100. It says 10% coupon. So that's what I'm saying. 10% coupon is $100. So the payment is 100. Interest per year is 13%. Remember it was 10% before. And number of years is 10. Compute present value. I've shown you the first non-intuitive relationship. Price of a bond is inversely proportional to the interest rate. If the interest rate goes up, the price of the bond actually comes down. It's very, very non-intuitive actually. And there are a couple of layers around it. I can't explain all of it simultaneously, but one of it is very algebraically determined here. If you actually go here, forget the finance. Basically think about it. Anytime your denominator increases, on top of it is increasing, as a power here. the value of the ratio is going to go down. As simple as that. It's just how bond pricing is set up. Another way, now if you want a finance intuition behind it, since the face value is fixed, if you have a higher interest rate, you need to start off with a smaller amount to get to that same number. You know? And there are many other ways to, But you guys have been great, I know you guys let me talk here and you guys are paying attention. I appreciate that. But it's simple material. I try to simplify it, but you have to soak it in. And the homework that you guys do is it actually helps you. Otherwise, it's like you just do some hand waving and it'll never crystallize. It'll never be definitive. David, do you agree? Putting together that formula sheet, right? Required some time, right? Eric, you had the best formula sheet. I'm gonna take a demo of that formula sheet. Yeah. I lost one, I got one, no problem. When RD rises above the coupon rate, the bond's value falls below the par, so it says a discount. So here's like a new term, a discount bond and a par and a premium bond. So in this case, the discount rate went above the coupon rate. The coupon rate is 10%, and this is a discount rate. So what happens? The par value of a bond was 1,000. Now it became less than 1,000. That's like 800. So it's called a discount bond. Think about it like this. The market is generating 13%, and you're stuck with a bond that is generating 10%. That's the coupon. Would you like to have that bond? Not really. So its value goes down. This is also a very, slippery kind of a topic. Is this discount rate, and because the discount rate actually happens when the market rate is higher, so it's counterintuitive. I'll show you the opposite. It's like you have to go back and forth. Suppose what would happen if inflation fell and the market discount rate declined to 7%? Well, let's just change it to 7%. Remember, 837 was the present value of a bond at 13%. Let's change it to 7. IY, compute present value. Minus the 1210. Bond traders are happy when the interest rates go down. In fact, I may have said in this class, it's like an economy where the interest rates are going up is basically, there's problem there. But too low is also a problem. That's why there's no absolute truth. Especially in social sciences, how can it be? There's no recommended value. Too low is a problem. That would be like extreme recession. Too high, the value of assets will go down. So as the interest rate goes down, actually, the price of the bond, you see, goes up. In this case, the coupon rate, so here's very simple intuition. I mean, this is called a premium bond. Why do you think it's a premium bond? You are holding a bond that is generating 10%. The market is offering 7%. You would like to hold on to that, right? That's if you were an original holder. But once again, no free lunch. I really want to mention this to you guys, that a premium bond is not necessarily, it has nothing to do with that it's a better bond than a discount bond. It just shows that its price is higher than the par value. You know why? Very simple. If suppose you wanted to buy a premium bond, a bond that is offering you a coupon higher than the market rate, you have to pay more for it. So market equalizes, You're not getting any, so the issuer of the bond is not foolish that they're going to give you, the market will charge you more. They say, sure, we'll give you higher. It makes you happy to get 10% a month when the market is offering 7%? Sure, we'll make you happy. You know what? Pay up for it. That's a street discussion on that topic. Yeah, just pay up for it. Simple. Suppose the bond was issued 20 years ago and now has 10 years to maturity. What would happen to its value over time if the required rate changed at 10, 13, or 7%? So something like this is going to be in homework and, exam, for those of you doing an exam, is And not the online guys, okay, so don't think there's an exam there because you guys are doing different things. But on this graph, you see that time is running in reverse. Is years remaining to maturity is what matters to a bond holder, not what the maturity of the bond is, because they're traded every day. So in this case, if n equals 30, we can do that. If n equals 30, let's change n to 30. N is 30. The discount rate is 7%. Compute present value, 1372, which is what you see there. Now you've held this for 20 years. At 10 years remaining to maturity, n equals 10. Compute present value, 1210. See, it's 1210, 1211 here. The coupon rate is 10% for both the cases, for the premium bond and for the discount bond. What is mattering is it becomes the same par bond becomes a premium bond if the market discount rate goes down to 7% relative to the 10%. But notice something interesting happening. That's why I said that don't think that you're getting a good deal or one thing is better than the other. The value of a premium bond continuously declines over its lifespan. And the value of a discount bond continuously increases over its lifespan. This would be nice little homework. It's just like I showed here. Do n equals 30 at 13%, you should get 775 here and 837 here. There's a lot in this graph here. So I've already said this. At maturity, the par value of any bond must equal its par. The value of any bond must equal its par value. The premium bond decreases, and the value of a discount bond increases over time. Yield to maturity, showed you the formula for that. Let's calculate yield to maturity. Suppose what's the yield to maturity on a 10-year 9% annual coupon that sells for $887. So you got a 10-year bond selling for $887, and the annual coupon is 9%. Notice this annual coupon 9% I converted to dollars, so that's 90. We don't know now what the interest rate, applicable interest rate is. Looks messy, but as you can see, I'll simplify it. We know the int, which is 90. The final amount is 1,000. Discount rate, this is your variable here. And you actually even know the value of the exponent. In this case, it's 10 for these items and 1, 2, 3. Or what you can do is future value 1,000, payment 90, present value minus 887, n equals 10, compute IY is 10.91. Take my word, it will be 10.91. Interest of time, not punching in the numbers. All of this I've said, if the coupon rate is less than the market discount rate, the bond sells at a discount. Basically, the market is offering you a higher rate than what the bond is offering you, so its value goes down. And the inverse relationship between price and interest rates. In fact, all of that is encapsulated in this here. So you have a negatively sloping relationship between bond values and interest rates. As the interest rates go up, the bond value goes down. So you can recreate some of these points here. This point, this point, this point. 10-year bond, 10% coupon converted to $10, $100. 10% of 1,000 is 100. Future value is 1,000. And tried at interest rate of 12% and 8%. So that's 12% and 8%. At 8%, draw a vertical line here. It's going to be 1134. At 12%, the line hits here. It's 887. No new information, just a different way of just showing that. Why is this graph looking different? Because on the x-axis now we have required return, whereas that was held constant in the previous 1 year. We had time there. See, just by changing what's there on the axis, you will have different shapes for the same entity. See here, the bond value is there on the y-axis in both the graphs. Here you have time. In the other one, you have the interest rate. So the interest rate here is stale because we're trying to show something different. These are sort of big ticket items actually, but you have to digest it. What is the yield to maturity if the price were 1134? The current price is 1134, everything else remaining the same. The interest rate, the yield to maturity is going to be 7%. Just throwing numbers at you? No. If it's 887 is the present value of the bond, the yield to maturity is 10.91. This is a discount bond. If you buy a premium bond, you're paying more for it, right? Your yield actually declines from 10.9 to 7%. That's what I meant, no free lunch. So you're buying a premium bond. Because you're paying more money for it up front, your total yield to maturity on that is actually lower. See? Why is it selling at a premium? I know I've said the concept I've already mentioned, but basically the coupon is 9%, which comes from $90, is greater than the market discount rate, or the yield to maturity, which is 7% here. And so naturally there's a bigger line in front of the window here. It's like, okay, you know, maybe these bond issuers are foolish, but they're not actually. They're charging more upfront. Homework questions on these items here. Current yield, capital gains yield. This is actually basically in a way embedded in the whole algorithm for the big charts paper. It's amazing that 1/3 of this equation is not factored in most web charts, and it's so elementary. In fact, I know all of you have read it. The last line in that abstract is the solution is in elementary finance. In fact, I actually pulled up, I try to make impact in my own ways sitting in Orno, you know. Morningstar has changed what it's showing. Morningstar is one of the, it is not one of the, it is the institutional site that investors go to. See here, Morningstar, but it's like so, I mean, look at that. I mean, look at these graphics here. It's just so old style. It's like 5 years, 10 years. That's all you get. You can't even put in your own dates here. But notice here, this was one of the recommendations in the big charts paper. So here's your total price here. You can click here, and if you're a big fan of returns, they'll show you a growth of $10,000, but even there, you won't get the percentage. What is the percentage return? I mean, and look at these graphics here. I mean, you have to start at 2007, and I mean, you can't even see the numbers. So you have to just assume one is like 13,000, 13,500. It should not be that difficult, but at least thankfully, they're giving the user the option to have price returns or total returns. But it's linked to this here. So with bonds, one of the items that you look at is current yield. The current yield is the annual coupon payment divided by the current price. A mistake that is often made is use the par value. So it's because then it's a boring number. So that's $90 divided by 887, not 90 divided by 1,000. The capital gains yield is the change in price of the bond divided by the beginning price, like 100, 110, like that. So the expected total return to an investor holding bonds is the expected current yield plus the expected capital gains yield. 99% of web charts actually, not 95, 99% of them are just showing you the expected capital gains yield. And I'll show you like numerically. So find the current yield and capital gains yield for a 9% coupon 10-year bond when the bond sells for $887. So what is the current yield? $90 divided by 887. That's 10.15. Just throwing numbers at you? No. Think of it. That's the yield on investment at a regular interval. You invest 887 in the bond, you're going to get $90 at the end of the year. That's what it's yielding. Just that. That's a pretty decent number, right? 10.15%. Now see what happens. What is the capital gains yield on this? That means what is the change in the price of the bond? Do you expect a big change in the price of the bond? Not really, because bonds are not designed for price appreciation. So yield to maturity is current yield plus capital gains yield. So capital gains yield is yield to maturity, which we calculate is 10.91 minus 10.15, that's 0.76%. That's it. Now you can understand why the web charts are always flat, because they're compounding this small number, you know. It's a price change. 1 year price change is very small. Most of the returns to a bond, they come from the coupon. Coupon they're ignoring just because it's hard to calculate, I guess. I can't imagine in this day and age with all the computing we have, it should not be hard. You can also calculate the second way I'm showing here is because the capital gains is over 1 year, so change the 10 to 9, so 9 years remaining. IY 10.91 we calculated, and that'll give you a present value of 893. So the capital gains is, you bought it for 887, you're selling it for 893, that's again that 0.77%. So it's a little detail, but for those of you, you know, want to crystallize this idea, so it's basically this way you can get the capital gains yield without calculating the current yield. That's what I'm showing you here. And this is using the calculator. That's using a concept, this is using a calculator. This is a dicey topic here. I really want you guys to focus on this. I know we've been at it for an hour now, 1 hour and 5 minutes. What this is, guys, is yet another demonstration of no free lunch. I mean, this is a really big problem for bond investors. Let me see how I can do this. It's not easy. I don't want to gloss over it. I try not to gloss over anything anyway. What is the interest rate of this? Is called the interest rate risk. Basically, let's start with the basic. The interest rate risk is the risk to a bondholder from basically a rising interest rate. So if the interest rate rises up, it's a risky situation for a bondholder. And I'll show you, one, why it's risky, and two, that there's a differential impact. It's the differential impact which is the subtlety, which is what I'm interested in showing you. Because eventually it will hit you. Because you will have to make a choice someday whether to go for the Vanguard long-term bond or the Vanguard short-term bond index. And you'll realize why there's no free lunch through this set of numbers and the picture associated. The picture is basically representing all these numbers. We got to get to the numbers first. To start 10%, $1,000. And this is a 1 year bond, okay? You may want to write some things down. This is a 1 year bond and this is a 10-year bond. Let's do the 10-year bond. So 1,000 is the face value, 10 years. It's 10%, so the payment is 100. At 10% interest rate, we should get compute PV of 1,000. There you go. All right, now that we established the benchmark, guys, let's say the interest rate goes down to 5% on a 10-year bond, okay? Let me do 5% here, 5% on a 10-year bond. So here I'm actually not showing you numbers, I'm actually trying to show you a concept, and that there's an asymmetry in the impact. That if the interest rate declines to 5%, let's compute what the value of the bond is going to be. 1,386, people are happy. You can now see, very simple, the calculation is there's basically an appreciation of 38%, right? If now the interest rate goes up to 15%, the bond price declines sharply to 749. However, the price change is not symmetrical. It's 5% change in both the settings, but here it's a 38% increase in the price, and here's a 25% decline. Now, if you change it to n equals 1, compute present value, you get 956. So you have a 4% decline. So there were two sets of investors here, the short-term investors and the long-term investors. So as the interest rates went up, the short-term investors are happier. They're both unhappy. They both lost money. But then Schadenfreude kicks in, right? Schadenfreude, you know that? Schadenfreude, that means it's a German word. It's an interesting word. It's not a good word. I mean, it can be used. It's not a bad word in that sense. Schadenfreude is when people derive satisfaction from seeing other people in miserable situations. So this is Schadenfreude right here. You lost 4%, naturally it's not good for you, but the other team lost 25, you're doing fine, right? Right? You were smarter, right? However, now let's say interest rates went up to 5%, went down to 5%, compute PV, 1047. The investors in the 1-year bond gained only 4%, 4.8, whereas these guys gained 38%. What I just demonstrated to you is these two very dangerous lines, and it's a problem of choice. Now, whether to invest in bonds or not, that's easy. Especially you read my paper, read Sharpe's paper, all that, you got to have bonds in there. The problem is of choice, Choice is always the problem. Should you get long-term bonds or short-term bonds? Because here's the problem. If the interest rates decline, your short-term bonds will go up, but not as much. But if the interest rates, God forbid, they go up, and you have long-term bonds, you're going to get hammered. So then you will like to have the safety of the short-term bonds. So that's the problem of choice. It's like whether a town should have a fire station or not. That's like not even a question. We should have the fire station. The question is how big the fire station should be. Right? You have a really big fire station with big fire, it'll take care of it. But a big fire may happen, every 10 years. Whether we should have dinner tonight or not, that is not even the question. We should have dinner. But the choice is whether you want to go for the third serving of the apple pie with vanilla on it. That is the problem. Same problem here, guys. Short-term, long-term, I've shown you a differential impact. And I don't have an answer, folks. I'm very sorry. I don't have an answer. But I have shown it to you. The fire station, remember the fire station problem or the vanilla ice cream problem. You will have to make that choice. And remember, the mother of all market variables is the interest rate. You cannot predict the interest rate. That's where my MAC paper comes in. It literally distances itself. It's what I call the second best solution. First best solution is we can see everything in the future. So I gave up on that. Can't see it. Can't forecast it. Maybe you can forecast it, but not consistently. So this MAC investing paper, how it says that you basically have a stable investment allocation in each of them, and it draws from the Harvard Business School case. By now you've heard default risk in bonds. I just showed you interest rate risk, and just when you thought we're done, I'm throwing reinvestment rate risk. Reinvestment rate risk, actually I'm just dealing with it right now. I just got an email this morning from my bankers. They said, Pank, we liquidated your CD. Thank you for having it with us for 5 years. And you know what? I locked in. I locked in 4.2% at a high quality bank. 4.2%. I am dealing with reinvestment rate risk, which is all this instruction here. The risk that cash flows will have to be reinvested in the future at lower rates, reducing income. So now I got the whole CD with the interest in it, and I'm looking at 0.1% versus 4%. So 10% is 50,000 of 500. So that's your year one income. Excuse me. However, the rates fall down to 3%, your income is going to drop to 15,000. But if you had bought the 30-year bonds, your income would have stayed constant. So basically, you're saying the reinvestment rate risk, a lowering of the interest rate, the new applicable interest rate reduces uh, the new interest income flow that you will have. And that is the reinvestment rate risk right there, which hits the short-term bonds more than the long-term bonds. So basically, with long-term bonds, you have high interest rate risk and low reinvestment rate risk. For short-term bonds, it's the opposite. You have low interest rate risk and high reinvestment rate risk for the principal. The low interest rate risk is for short-term bonds is basically as the interest rate will go up, the delta, the price change on the bonds is going to be lower, as I showed in the previous graph with the less elastic slope there for the short-term bonds. Bottom line is basically nothing is riskless, and it makes it difficult for a bond investor, on how to diversify. But this is a different kind of diversification from stock diversification. Now you know where the no free lunch comes from. So this is sort of an interesting situation here. I want you to think about this. It has a little um, thing about the coupon in there that I want you to focus. This looks like a daunting formula, but basically this is a semi-annual interest rate calculation adjustment that is required in the bond pricing formula. And basically most of the bonds, they are actually, the interest is paid semi-annually. So think of a pizza, and if more people show up, you just make more slices of the pizza. It doesn't mean that there is more pizza. So here you will see that the interest rate, which is the payment, the periodic payment or the coupon, is divided by 2. The number of periods, they increase 2 times, and the yield to maturity or the discount rate is cut into half. The current price of the bond and the maturity value of the bond, it stays the same. But I'll show it to you on a calculator as well, but that is the basic formulation there. That's M, the maturity value. That's INT, which is also PMT on your calculator. This number of time periods is the compounding periods doubles even though the total time is the same. So if it's a 2-year bond, semi-annual, that's 4 compounding periods. So here is the same setup there, except that it's with respect to the calculator keys, and you notice that n becomes 2n. Discount rate is cut into half. Present value and future value stay the same. And int, which remember is in dollars, so it's in percentage, but it gets converted to dollars. And so we go from theory to calculator to actual numbers here. That's a 10-year, 10% coupon. RD is 13%. So see, we have 2 percentages there, 10 and 13. You gotta be careful. The 10% is 10% of 1,000, so that's $100, and you divide that by 2, so that's how you get 50. And RD is 13%, but that's the annual rate. So per 6 months, it's 6.5. Number of compounding periods is 20. So if the annual rate is 10%, what is the effective rate for a semi-annual bond? So since it's compounded twice, the effective rate is actually higher, 10.25%. And you can actually use this formula, or you can use the icon button, which is on your calculator under the number 2. So your nominal rate is 10%, hit the down arrow button, and compounding periods per year is 2. And you want to calculate the effective rate, hit the compute button, you get 10.25%. So basically it's a better deal for a lender, which is basically usually you and me, uh, to invest in a bond which has higher compounding periods per year. Nowadays it's basically, everything is compounded on a daily basis. Here's an interesting question. If $1,000 is the proper price for a semi-annual bond, what is the proper price for the annual payment bond? So since you get, with semi-annual compounding, the effective rate is 10.25%. Once you apply that to an annual bond, which is of 10 years maturity, you'll actually see that the present value of the bond is $984. So basically, once the semi-annual compounding feature is removed from a bond, its value diminishes, and it diminishes by about $16. Because if both the bonds are issued by the same company, the riskiness is the same. The effective rate should be the same for both of them. And so another way to look at it is you invest less with an annual bond, and it also goes to 1,000. And so you have to invest less to have the higher 10.25%. It's something you want to think about. It is also the basis of arbitrage, such discrepancies, which will be on the next slide. So at a price of 984.8, the annual and semi-annual bonds would be in equilibrium because the investors are earning 10.25. And this is actually, bond traders monitor these things. They will not pay more than 984. If it is more than 984, they'll short it, and they'll go along a similar bond from the same company with same risk, and they'll collect the difference. If you heard there's someone called the London whale, and these trades, there's just a couple of dollars of difference, but if you make like a $500 million of trades, and it's the arbitrage window, then your total amount of profits generated can be significant. So basically the semi is actually costing more because it has a feature of semi-annual compounding. And once again, and I'm repeating there's no free lunch. If you really think about it, finance, the risk return trade-off is literally like the equivalent of gravity that we have in physics. It all revolves around that. You can have different factors, as they say, like sales ratios, and price to earnings, but all of them are basically a proxy for risk. And risk will eventually manifest into return if properly taken. This is an example about yield to call. That's something that I do only at the grad level. So in this case, you have a 10-year, 10% semi-annual coupon, $1,000 par value, selling for 1135.9 with 8% yield to maturity. It, however, can be called after 5 years at 1,050. So now the future value is no longer 1,000; it's 1,050. And so the question is, what is the bond's nominal yield to call? And a similar problem that we did, actually right here, the yield to maturity is 8%, but because it's going to get called before, you'll see that the yield to call is a lower 7.53%. The present value is 1135.9. The payment is 100 divided by 2, that's 50. And the number of years is actually 10, because
it's after 5 years. So the remaining is n equals 5. So it's 5 times 2 is 10. So it's not like we have forgotten to multiply by 2, even though it says 10 years, but what is applicable is remaining 5 years. And so you get 7.53% on yield to call. So these are callable bonds, and basically that gives the issuer of the bond to call back the bond in case the interest rates go down, thus protecting them. So basically, if you bought bonds, would you be more likely to earn yield to maturity or yield to call? Well, you're more likely to earn yield to call because the issuer, they could raise money by selling new bonds which pay 7.53 instead of being locked into paying 8% a year. And however, for this call feature, they have to pay more, which is a face value, changes from 1,000 to 1,050. Once again, there's no free lunch for either party. Now, this is relatively the soft section of this chapter. Um, this is about bond ratings. There are primarily three companies: Moody's, S&P, and Fitch, which is going to be on the next slide. And they basically rate bonds. Now, stocks are not rated, but bonds are rated because some of the bonds, they're actually not even publicly traded. But if a bond is not rated, it is difficult to value, how much risk it has and what are some of the features. And that this is where this used to be a very boring section, but it became very alive with the downgrade, the U.S. credit downgrade of 2011, um, where the whole country was downgraded, and before that, the 2008 financial crisis, where the mortgage-backed securities were incorrectly rated by the rating agencies, and it created a lot of disruption and loss of value throughout the economic system. And basically, AAA ratings, AAA to triple B is investment grade, and anything below triple B by S&P, which is BB or BA. So you have to be careful, which rating, who's the issuer of the rating. So BB can be junk, and BA can also be junk depending on who is issuing it. So here you have Fitch also that comes in, and basically um, you you see the junk ratings are below BA, BB. This table looks like a lot of numbers, but this is what finance researchers do. If you look at the CC, that's the junk section, you see that there's 25% default rate throughout for most of the years, and so you have to be careful when you invest in junk bonds. But junk bonds, they basically trade like small cap stocks, and so bottom line is, if you aggregate them, the investment grades have a default rate of 0.06%. The speculative grade has a default rate of about 4%. And so depending on your risk tolerance and your portfolio objectives, you can invest in either or both. But nowadays with ETFs, you actually get diversification. So you can invest in a portfolio of junk bonds instead of having just one junk bond. Because one junk bond, you invest in it, and there's a 25% chance it's going to go to zero. Imagine that. Whereas there's a ticker JNK, which I'll show soon. And that gives you automatic diversification across different junk issues. By now, you are seeing that bonds have a lot of different types of risk: default risk, interest rate risk, reinvestment rate risk. What factors affect default risk and bond ratings? Some of the well-known factors are debt ratio, coverage ratios, EBITDA, which is earnings before interest, taxes, depreciation, and amortization, current ratios. So all of this is, there's this whole section of financial accounting, and there's a lot of material to cover in this class. And I, I just know that all of you are having accounting classes, and you can read the chapter on financial accounting. Is basically a set of rules, and it's linked to finance, but it's not exactly the same. And because of market efficiency, these factors are actually already factored into the pricing of a security or the risk of the security. But anyway, a high debt ratio, that's basically make the bond riskier. Issues with bond ratings. The next couple of slides, they're sort of qualitative in nature, but I do want to draw your attention to a couple of items. Um, that why do bonds have ratings? Well, basically, the issuers want ratings to improve liquidity. Otherwise, there's no way for the market to assess the quality of a bond, and that's where some problems happen. I mean, this third line is the root source of the problem. They even pay for the ratings, good or bad. So that's where the corporate jets and those special tickets to Super Bowl and all that come in. And sometimes ratings that should not be given are given and assigned to a security. And in the end, somebody has to pay for it, be it the investor on Main Street or a large institution that's investing in it, or even the government, and eventually, which is the country and the taxpayer. So that's where you have to be careful about what you're looking at and what you're investing. And it's sort of a theme of my research and everything. And I try to get it across in my class that you have to do your own diligence. So, I mean, you can see it right there that a company can assign a rating to a bond and it would mean nothing because actually the rating is incorrect. It's like somebody doesn't show up to do their work, do anything, and they get assigned an A plus. And so they go into the next department thinking the other manager thinks that they're good, they're going to do things, and then they are stuck with something with a person who doesn't even show up for work. As someone said, 95% of the battle is showing up. Other 4% is showing up on time. And I guess 1% is the rest. There was actually a question about John Hancock, and the reference to John Hancock comes from that be careful with your John Hancock. And John Hancock, as most of refers to your signature. And during these bond ratings, what happened is some of the junior analysts they got busted, and eventually the blame was put on them because it was their signature. But as you guys can imagine, um, it was pressure from the corporation above that made them agree to certain bond ratings that they were issuing to the borrowers, and they were not warranted. But eventually, when the subpoenas came, the person with the John Hancock, they are the ones who were into trouble, and civil and criminal proceedings were initiated against them. So more issues with bond ratings. The technical one that I want you guys to remember is this last bullet point there. That is a AAA rating, a protection from a drop in the value of a bond. I mean, we've talked so much about this that it's like, okay, a AAA rating is very good, but I do want to emphasize here that what do you think is going to happen to the value of a very safe bond if the market interest rates increase? Well, if the market interest rates increase, it's going to drop. The value of the bond is going to drop because of the inverse relationship that we have between the price of a bond and interest rates. It's as literally arithmetic, as simple as that. Ratings, they only reflect default risk, not interest rate risk or other risks. So the bottom line is you can have a AAA rated bond, and if the interest rate goes up, you will still see loss in the value of the bond. So we towards the end of a chapter on bonds, which most people think are riskless or very low risk, and here we are. um, putting on the table the different sort of risks that are associated with investing in bonds, right? From rating risk to default risk, to interest rate risk, which is price risk, and reinvestment rate risk. And these are last 6 slides on bankruptcy. And Mark Twain said investors should be concerned about the return of their investment rather than the return on their investment. So if you think about it, the difference is subtle, but it's significant. The return of your investment rather than the return on the investment. The minute you invest, the first thing that starts happening is that, are you even going to recover your capital? The two main chapters of the Federal Bankruptcy Act, Chapter 11, Chapter 7. Chapter 11 is what is basically known. Typically, it's people actually even don't even say bankruptcy. They say, oh, companies in Chapter 11. Some famous ones are J.C. Penney, Kmart, even General Motors as recent as 2008. If you go Google General Motors bankruptcy, you'll see like a 2-page PDF with their signature on it, which was the end of a company that was one of the original Dow components. But then they reorganized and they came back to life. And in fact, right now, Lee Iacocca, if some of you remember that name, Chrysler CEO, and that was a good one of the three major automakers. And in the late 90s, actually, it went private. And now I'm reading that there's gonna be an IPO on that as well. So this is a lot of the corporate side of finance. A lot of activity happens there, and typically, the company management is really worried about bankruptcy because even if they are not the owners of the company, what happens when a company is acquired or it becomes a target acquisition? The acquiring company, they basically, replace the existing management with their own management. So that creates an incentive for the existing managers to do a decent job. Liquidation is when the reorganization is not successful and basically the company is liquidated. Just sold, the assets are sold out. And you get pennies for the dollar invested. The stockholders don't even get a letter actually. Both stockholders and bondholders, they pretty much have 100% loss on their investments. The bondholders can get a few pennies on their dollar, but the stockholders, because they are equity holders in there, if a company closes bankruptcy proceedings, they get nothing. If I don't know if you guys have thought about it, but there's a little asymmetry in the return distribution for stocks. On the plus side of the distribution, the Gaussian distribution can go up to infinity, the returns, at least 100%, 200,000. And on the left side is capped at minus 100. You cannot lose more than minus 100. And this is a chart here that basically shows the inverse relationship between the price of a bond and the interest rate. And I could not create such symmetry, but yeah, the black is TLT, which is one of the biggest bond ETFs. As you see, whenever it goes up, the interest rate goes down. So the second associated ticker there is TYX. If you want to be a real investor, you want to follow TYX because that's the Treasury Yield Index. And in hindsight, it looks like there's a nice sinusoidal relationship, but right around that point, the place I'm pointing, you may actually think it's going to revert back. The interest rates will go up, so the price of bonds will go down, and so you can make a short trade on it. But that would be a very problematic situation because the interest rates keep going down, bonds keep going up. By the way, since you guys are doing the portfolio, want to mention this to you because I've seen even some professional investors make the mistake of shorting bond ETFs. Bond ETFs, they generate a lot of income every month, and if you're short on a security that pays dividends or interest, you actually have to pay it back. So, so that's a continuous hemorrhaging of cash flow from your portfolio. And that's something that you don't want to do, obviously. And you have some tickers associated with various broad asset classes: equity, equity tech, US bond, real estate, gold.